What are you expecting to hear from him when it relates to stimulus and perhaps more importantly for the markets when it comes to the Fed's accommodation policy?
Well, you're right. We're not expecting much in terms of the policy announcement itself. We are looking for rates to remain unchanged, as well as asset purchases steady at 120 billion a month. But really, where the excitement comes in is the press conference and the updated SEP, or summary of economic projections, where we could see the committee actually upgrade its forecast for growth in light of the president's latest 1.9 trillion stimulus, potential additional stimulus coming down the pipeline, and of course, an expedited vaccination process. As far as the press conference, we do think that he will be pressed on the president's latest rescue fund and whether that was a net positive for the economy or if additional funds are needed. But the big focus, as you mentioned, will be around the latest reaction in the market and rising inflation expectations. Now, the Fed has danced around that more recently, suggesting that the recent volatility is not something to be concerned of. And in fact, if it is later deemed disorderly, the Fed is willing and able to step in to control additional volatility in the market, or specifically longer term yields. But as of right now, the Fed does not seem concerned about inflation, with both headline and core readings still well below the Fed's 2% target.
So, Lindsay, the Fed does have a dual mandate to deal with, the cost of things and also unemployment. So with inflation at about 1.7% over the last year, but real unemployment closer to 10%, that's according to Jay Powell just a couple months ago. How do they fulfill that dual mandate going forward?
Well, right now, there really is no incentive for the Fed to adjust policy. As the chairman has been very clear, the economy is still struggling to gain momentum from these low levels that we've seen since the onset of the crisis. As you mentioned, the civilian unemployment rate reported in that non-farm payroll report is much lower, around 6%. But if we look at some of the lingering unemployed, if we look at some of the Americans that have dropped out of the labor force, that number is much higher. So from a full employment standpoint, the Fed doesn't feel pressure to raise rates. On the inflation side, yes, we are inching closer to that 2% level, but we also have to remember that the Fed's framework around inflation has been adjusted. They're now looking at a flexible average inflation target. So essentially giving the Fed more wiggle room around inflation, potentially allowing inflation to run hot, at least temporarily, again, before adding pressure to the committee to lift off of these low rates. And in fact, with inflation at just 1.3% on average since 2015, the Fed could essentially allow inflation to push closer to 2.5% or even 3% for the next several years and still not exceed that longer term average of 2%. So translating into what this means for rates, lower for longer for quite some time, I would say.
All right, Lindsay, you're certainly take a longer view. Before we let you go, I just have to ask, we know that press conference comes at about 2:30 this afternoon. How do you see the markets reacting with what you expect Jay Powell to say?
Well, as we do look for the Fed to sort of back off of these fears of inflation, the market may read this as the Fed taking a relatively nonchalant look or nonchalant position to inflation, which may exacerbate some of the recent backup activity that we've seen in the market. Of course, we've seen the 10-year yield back up about 80 basis points since the start of the year, and we could see at least somewhat of an upside risk or volatility after that press conference if the market misreads or doesn't interpret the Fed as strong on inflation control.
Shepard Smith here. Thanks for watching CNBC on YouTube.